All right, good evening, ladies and gentlemen. This is June Collier. Welcome to Stock Investing for Complete Beginners. We've got another banger for you here tonight. I do want to start off, however, apologizing to you guys because I usually give you tests during the week to just make sure that you have grasped and understand the concepts that we covered that particular week. And this is the second week that I haven't given you a test. I've just had some real personal things that's going on in my life right now that has sort of taken my mind away from some of the things that I need to be doing. My goal is to go back and create those tests for those of you who do like the test, who want the test. So my goal will be to go back and create those tests for you. I also want to give a shout out to Miss Barbara. Last week, we were talking about dividend investing, and we were talking about ex-dividend date. And as you know, ex-dividend date, you have to have the stock by ex-dividend date in order to get paid the next dividend payout. And so the question was, if ex-dividend date is on the 6th of December, can I purchase the stock on the 6th of December and qualify for the dividends next? And the answer is no. I was incorrect. I said you can actually purchase it on ex-dividend date, but you have to have it the day before ex-dividend date. So if ex-dividend date is the 6th of December, you have to purchase the stock by the 5th of December, okay? So just want to shout out Miss Barbara. She was correct in that. You know, we always got to, when we make a mistake or we say something wrong, we want to make sure that we correct it. So thank you, Miss Barbara, for holding my feet to the fire on that one. Gotta always do that. Now, tonight, what we're going to do is we are going to cover several different pieces of lessons that I wanted to cover. And so hopefully we'll be able to cover all of those different pieces of lessons here tonight. And then next week, I got yet some more stuff that I want to cover with you. I wanted to end tonight, but you know, I don't want to shortchange and cheat you guys. So I got to give you everything that I know to give you for you to be successful. So let's go ahead and jump into, there's actually 3 trainings that we're going to do tonight. So there's going to be 3 different PowerPoints that we're going to do tonight. And hopefully we'll be able to get through all of those here tonight. So let's go ahead and do that. Let's see. Here we go. There we go. So the first training that we're going to talk about is we're going to talk about stock splits. And you may have seen this in one of the weeks. I kind of dropped this in there, but we never talked about it. We never trained on it. But I want to talk about when a stock splits, because stocks will split. If they don't split, they become extremely expensive. And so we'll talk about how stocks split, why they occur, and then the effect that they have on the price of the stock, okay? So the goal of this training is to teach you what a stock split is, how it works, and why companies sometimes use stock splits. So let's take a look at what is a stock split. So basically what we're going to do when a company does a stock split, they increase the number of outstanding shares by issuing more shares to current shareholders. Now, probably doesn't make a whole lot of sense. I'm going to break it down for you. You can own more shares, but it adds up to the same amount of money. So when a stock splits and you get, let's just say you have 1 share and the stock does a 2-for-1, you get 2 shares for the 1 share that you had. Doesn't mean that your price, your money went up at all. It just means that those 2 shares now are worth the 1 share. Now, companies split stocks to make it more affordable for more investors. So typically you'll see a stock starting to split when it starts reaching, you know, a relatively high price. So maybe $500, $600, $700 a share. The company will do a 2-for-1, a 3-for-1, a 4-for-1 stock split to bring the price back down to a reasonable amount that encourages new investors to invest into the stock market. It often happens when the price has gone up and the company expects the price to continue to go up. So oftentimes a stock split can be a positive sign that the stock is going to continue to go in a higher direction. So if we look at the image here on the left, we have this young man. He has a stock that's worth $4 a share. The company does a 2-for-1 stock split. So now he has two stocks worth $2 a piece. He didn't lose any money. He didn't make any money. It's all the same. Okay. You got $1 in your pocket, and then I give you 4 quarters. It's still $1. You didn't lose any money. You didn't make any money. It's just now you got 4 coins instead of that $1. Think of that as a stock split. Okay. Now, let's talk about market cap, because we've talked about market cap in week number 1. What is market capitalization? That's the value of the company. So we take the number of outstanding shares that the company has, multiply it times the price per stock, and that gives you market capitalization. So for example, if you have 1 million shares and the stock is $20 a share, the market cap is $20 million. You multiply the number of outstanding shares times the price of the stock, okay? So that's one stock. Well, if we do a 2-for-1 stock split, basically what the company now has is 2 million shares, but 2 million shares times $10 a share. The market cap is still $20 million, okay? But it becomes a lot more attractive to people at $10 a share versus $20 a share. It's just a mind thing, okay? And you're going to see that because I'm going to show you some companies that have never done a stock split, and you're going to see exactly what I mean by why they actually do it, okay? So the only thing that changes with a company is the outstanding shares, okay? The value doesn't really change, all right? So I want to make sure everybody's got that. Now, let's talk about this. I want to give you an example of Apple. Apple did a stock split maybe 2 years ago. I think it was 2 years ago. But Apple was trading at $400 a share. So one share was worth $400. Then Apple did a 4-for-1 stock split. So that meant that for every 1 share that you own, they were now going to give you 4 shares. And because it was at $400 a share, and now it's 4 shares, 1 share now is worth $100. But you still have 4 shares, so you still have $400 worth of stock, okay? The reason why they do that is because, again, more investors would be interested in the $100 price, which will shoot the stock even higher. It'll take the stock back higher. You want people interested. You don't want people to look at it and go, "Ooh, that's too expensive." Even though it doesn't work that way, but the mindset of people and the mindset works that way. And so they keep it split so that it becomes attractive to individuals to purchase. Okay? All right. So would you rather have 4 quarters or $1 in the bank? I'm not going to say in your pocket because you want to have $1 in your pocket because you don't like all that change. But does it matter if it's 4 quarters in your bank account or $1 in your bank account? It doesn't really matter because they're both the same. Okay. And so that's what when we think about a 4-for-1 stock split, that's what we're looking at here. 4 quarters for $1. That's a 4-for-1 stock split. It still equals the same amount. It's just that it split it up into 4 quarters instead of 1 whole dollar. Now, let's talk about stocks that never split. So we're going to look at Berkshire Hathaway. Berkshire Hathaway, at the time of this, was $291,000 for 1 share. For 1 share, it was $291,510. So you can see why a stock splits, because if the stock doesn't split and the price of the stock keeps going higher and higher and higher and higher and higher, and the company never splits the stock, it will deter many investors from even entering into the market. Okay? But the capitalization doesn't change. So by doing the stock split, all I'm doing is I'm tricking your mind into believing that this stock is an affordable stock. I'm just tricking your mind, okay? Because if we never did a stock split on Apple or never did a stock split on Microsoft, it would probably be priced just like Berkshire Hathaway. All right. And even Berkshire Hathaway was smart enough to understand that not splitting the stock would deter many investors. So they created Berkshire Hathaway B class, which did do stock splits. So we're going to go out and look at that just for a moment. So we'll go here to Yahoo Finance. And we're going to look at BRKA. That's going to be Berkshire Hathaway A class. Let's just take a look at what it costs right now. So it's gone up since we did the training. One share of Berkshire Hathaway is $546,000 for one share. Okay. Now, if we look at the trend on this stock, we can look at the 5-year trend. It's in an upward trend. We look at the max. Great stock, but it's $546,000. Great stock. Okay. Or you can do like I did, because I wanted to own some Berkshire Hathaway, and you can get Class B. The Class B stock is $357. If I look at the trend, it's the same trend, but this stock has had stock splits. Okay. So see how the difference, you might say, I can afford that. I can go get me a couple shares of Berkshire Hathaway B. But then you look at Berkshire Hathaway A and you're like, I can't do that. It's pretty much the same stock. It's just that one has had stock splits and another hasn't. Okay. Hopefully everybody gets that. I don't see any questions in the chat. So that must mean that that makes sense. All right. All right. That's the Berkshire Hathaway B. And you can see back then it was $195. This was probably just 2 years ago. And this stock has doubled in price, right? I wanted to get some Berkshire Hathaway stock because I planned on going to the investors the earnings call, and I wanted to go to the earnings call, so I needed to be a shareholder to get some of this. And then the pandemic hit, and I never made it to the shareholders meeting. All right, now there's also something known as a reverse stock split. So when we say 4 for 1, that means that the stock is going higher or the price of the stock is going to be split. But sometimes they do a reverse, a 1 for 4, right? They'll do a 1 for 4, which means for every 4 shares of your stock, they'll convert it to 1 share. Now, they do that because usually when you see a reverse stock split, the company is in trouble. And what it's trying to do is it's trying to avoid becoming a penny stock. It's trying to look like it has a lot of value. Okay. So what it is you own less shares, but it adds up to the same amount of money. So any of these splits, whether it's a regular split or a reverse split, the money is the same. Okay. But a reverse stock split prevents the stock from being delisted or to improve the company's image if the stock has dropped significantly. So what you may end up seeing is, let's just say that the stock has dropped down to, I'm gonna make the numbers easy. Let's say that the stock has dropped down to $1. It's dropped down to $1 a share. And the company might, in this example, it might do a 1 for 6 or 6 for 1 stock split. And so what that means is that now for 6 shares, they're going to convert 6 shares into 1 share. So they're going to take your 6 $1 per share stock, and they're going to combine those 6 shares into 1 share. And so now 1 share, instead of being $1, 1 share is going to be $6. And it makes it look like one share is bigger, right? To prevent becoming a penny stock, because that stock is dropping in price and they do a reverse stock split, right? So this is what a reverse stock split looks like. They take 100 pennies and they take that 100 pennies and turn it into $1. So what we do on a reverse stock split is we take all of our stock or all of the stock and you combine it and turn it into one stock. Okay, so in this case, it would be a 1 for 100, a 1 for 100 stock split, reverse stock split. All right. Any questions on that? Some people might have a question on that. Okay. So a prime example, again, this training was done a couple of years ago, but Office Depot was a company that did a reverse stock split. And their shares in Office Depot had dropped down to $2.35. So what Office Depot did is they did a reverse stock split, 1 for 10. And so now one share was worth $23.50. Basically, they took 10 shares of stock at $2.35 and converted it to one share. Okay. Now, when they do that, your outstanding shares also change as well. So they went from 526 million shares to 52.6 million shares because of the reverse stock split. So the market cap stayed the same. The only thing that changed was the price per share. Okay. So that's what a reverse stock split looks like. So you got to be careful on a reverse stock split. It is usually a sign that the company is just trying to improve its image. They're trying to prevent from being delisted from the stock exchange and going to the over-the-counter exchange. You guys remember that from week 1? So you got to be careful with a reverse stock split. Okay. All right. That's first training. Let's stop here and see if there's any questions on that before I move on to the next training. I don't see any questions, so I'm going to move on. If you do have questions, you can type them in the chat. You can type in the Q&A. All right. All right. So that was stock splits. We typically like to see stock splits, when stocks starting to get really expensive. When they do a stock split, it brings the price of the stock back down. And then new investors like to rush in and buy the stock, and then the stock continues to go back up. And so you start making some money in a stock split. Now, let's talk about exchange traded funds. I'm going to talk about exchange traded funds. Let's go ahead and share this with you guys. All right. So you may have heard the term ETF. And what ETF stands for is exchange traded funds. Now, an ETF is very similar to a mutual fund, where instead of investing in one stock, you invest in a basket of stocks. And the reason why you invest in a basket of stocks is for diversification, and diversification is to keep you safe. So if you only invest in one company, if that company goes down, you're going to lose money. But if you invest in an ETF and it has 500 companies that it invests in, if 10 companies go down, that still does not mean that the entire ETF goes down. You still may go up even though 10 companies in the ETF went down. Okay. And so basically an ETF gives you a diversification for your portfolio. All right. So we're going to talk about how to minimize your investment risk through diversification of exchange traded funds. Remember, I told you guys to get an S&P 500 fund. That's an ETF. That would be an S&P 500 ETF that has 503 stocks that are in it. And that's what the ETF is. Okay. So let's talk about this ETF and how to take advantage of it. An ETF tracks an index sector. Or let me say this. It tracks either an index, a sector, a commodity, or other assets. but it can be purchased and sold on a stock exchange just like a regular stock. Probably doesn't make any sense just yet. Now let's talk about ETFs versus mutual funds. Both of them represent a collection or a basket of individual stocks. Both of them are less risky than investing in individual stocks. They both offer a wide variety of investment options, and they both are overseen by professional portfolio managers. So when we talk about a mutual fund and an ETF, this is where they are very similar. Now let's talk about how they're different. An ETF operates just like a stock. The price of the ETF will fluctuate all day long, and it can be bought and sold just like a stock. A mutual fund is only traded once a day after the market closes. So if you decide that you want to get out of your mutual fund today, and you decide this in the morning you want to get out, you really are getting out at the end of the day. Whatever the price of the mutual fund is at the end of the day, you're getting out then. So you can't get out of a mutual fund in the middle of the day. It just doesn't work that way, okay? Now, an ETF has low expense ratios and fewer broker commissions. And here's the reason. Most ETFs are primarily ran by computer programs, computer software, okay? A mutual fund is typically more actively managed by actual individuals, mutual fund managers, right? And thus they will have a slightly higher expense ratio. ETFs are more tax efficient and mutual funds are less tax efficient. So a lot of people have been moving from mutual funds to ETFs because they're very, very similar in nature, but you have a lot more flexibility with an ETF. But if you think about it, an ETF and a mutual fund are very, very similar in characteristics. All right, let's see. Is it managed by a fund manager? So Robert, I don't know which one you're talking about because I'm talking about an ETF and a mutual fund, okay? So both are going to have a fund manager. However, the ETF is going to be managed more primarily by computer software. Computer software is going to be managing that ETF more so than what you would normally see with a mutual fund. How does the reverse stock split affect someone who may have a stock option of that stock? Your 100 shares would go below 100 shares. Okay, so one, we're not talking about options in this course. And so I don't want to confuse a whole lot of people about options. But so what would happen is that when, should I go there? Sandra, I'll take that offline. I'll take that offline because that would be a very detailed explanation. And we're not talking about options in this class. And so somebody's going to be like, well, what are options? And then that opens up another rabbit hole. Okay, so we'll talk about that. Great question, but I'll reserve that and I'll take that offline. All right. Now, let's talk about the different types of ETFs because this is where you're going to start to see some of the power. You can get a bond ETF. Now, if you guys remember in week one, what did we say a bond was? A bond was nothing more than a loan, but the bond is a loan that a company issues or the government issues. So you can get a bond ETF. Now, a bond ETF means that inside of that bond ETF are many different variables or different companies inside of that ETF. So if I get a government bond ETF, that ETF would have, let's just say I get a Georgia government bond ETF. That ETF is going to have the Georgia Dome in it. It's going to have the Atlanta Police Department. It's going to have Northside Healthcare in it. It's going to look at all of these government entities and have those government entities inside of that one bond ETF. Versus you going out and just buying a bond ETF, you can just go buy a bond ETF for the stadium, the Mercedes-Benz Stadium. You can just get a bond for just the Mercedes-Benz Stadium. But you may want to diversify and spread your risk out by doing a Georgia bond and covering multiple institutions, okay? Same thing for corporate, state and local bonds called municipal bonds. Those are going to be bond ETFs. Then you have an industry ETF. This is an industry that tracks certain sectors, like maybe you're into technology. So you would do a technology ETF, maybe the NASDAQ, okay? Maybe you're into banking, and instead of buying just Wachovia, you want to buy Wachovia, Bank of America, PNC, you want to do that. So you can get a bank ETF. Maybe you're interested in the oil and gas, but you don't want to just buy Exxon. You want Exxon, Chevron, and all of those. And so you can buy an oil and gas ETF. Then there's commodities. You got a commodity ETF. Maybe you want oil or you want gold, precious metals. You can do that. Maybe you want to do currency. A lot of people like trading Forex, but maybe you're like, hey, I don't know how to trade Forex like that, but I want to get a currency ETF, and you can invest in foreign currencies like the euro or the Canadian dollar, okay, or the yen. All of those would be inside of what we call currency ETFs. And then if you see that the market, or you think that the market is going to go down, you can always buy what's known as an inverse ETF. And an inverse ETF is an ETF that's designed to short stocks. Now, we haven't talked about shorting stocks, but that's when you make money when the stock market goes down. And so you can buy an inverse ETF, and that ETF really primarily focuses on stocks that are dropping in price. Okay, maybe the market is dropping and you buy an inverse ETF and they short the market and they make money shorting the market. Okay, so if you're not familiar with shorting the market or you're not strong in that, but you still want to participate, then you would buy an inverse ETF and let the professional shorten the market for you. All right. So hopefully that kind of makes sense on that. I see a question that came in. Are there any fees involved for ETFs and mutuals? Yes, there are fees involved with mutual funds as well as ETFs. And what we'll do is we'll take a look at a company called Morningstar. So Sonia, great question. Let's go take a look at a company called Morningstar. All of you should be looking at Morningstar. Morningstar is going to tell you what the expenses are for the mutual fund or the ETFs that you have purchased. So you guys remember, I told you if you didn't want to learn how to trade, just go open up a Fidelity account and go get FXAIX. Now we know because the letter ends in X, we know that that's a mutual fund, okay? Because the ticker symbol ends in X. So we're going to go over here and look at Fidelity FXAIX. And so what we're seeing here is you're going to see what's known as the expense ratio, okay? So this is the expense ratio that you are paying to invest in this particular mutual fund, okay? So yes, it does cost you some money to invest because you are having someone invest for you, okay? And then it tells you the assets that are inside of that ETF or mutual fund. In this case, this is a mutual fund. It tells you what's inside of that particular mutual fund. And you'll notice that there are 503 shares or 503 companies inside of this one mutual fund. So this is a great one. I love this one because you don't have to be so smart at getting it right, because I'm out here trading Microsoft and Apple and Amazon, but you can just say, I'm going to get this ETF and I'm in Microsoft, Apple, Amazon, NVIDIA. I'm in all the big companies that June's been talking about. June went out there and bought some Berkshire Hathaway Class B. I got that too. June got some Tesla. Guess what? I got some Tesla too. June got Amazon, Apple, and Microsoft. I got that too. So this is why sometimes a mutual fund or an ETF can be extremely, extremely beneficial, because instead of you trying to be smart and get, one or two of these stocks here, you can get all 500 of them and just ride the wave. Okay. You can get all 500 and ride the wave. And so what you can do is you can start comparing the expense ratio from one company to the other. Okay. All right. How many of these ETFs can you mix? I want to know what you mean by mix. Okay. I want to know what you mean by mix. An ETF is just is one ETF. In this example, this ETF I just showed you was the S&P 500 ETF. If you want to go out and get something else, you would go out and get a different type of ETF. Okay. So I'm going to give you an example. There's a company out there called Primerica. Many of you have probably heard of them. Primerica, financial services or something like that. But I'm going to do Primerica. Let's see if I can find an ETF or a mutual fund. Because I want to do a comparison. And I'm looking to see if I can find like maybe one of their mutual funds that they offer. Hmm. Okay, so Primerica has several of these different providers like American Century Investments. Um, let's go take a look at some of their. I'm just looking for one of their investments. I'm looking for the ticker symbol for one of their investments because I want to show you the difference and how you would compare it with, something that you got with Primerica. Does anybody on the call have an investment with Primerica? Um, let's do American Century Investments. Kind of going off a beaten path here. I'll figure this out a little bit later to show you the difference in expense ratios. Okay. All right. Let's get back on track. I don't want to get off track here tonight. All right. So we talked about these ETFs. Now, there are different strategies that you can use with an ETF. The first strategy is a very important strategy called dollar cost averaging. And so what dollar cost averaging simply means is that every month you put $100 in buying that ETF, and it doesn't matter how much the ETF costs. If the ETF's $50, you just bought 2 shares. If it goes up next month to $100, you just bought 1 share. If it goes down to $25 the next month, you just bought 4 shares. And what you're doing is you're dollar cost averaging, and usually with dollar cost averaging, you're buying more shares when the price of the stock or the ETF is lower. And so dollar cost averaging is a great way to do that. Asset allocation. So another way is to look at where you want to allocate your resources into what types of assets. So for example, maybe I want to put 20% in bonds, another 10% in technology, another 20% in healthcare. So that's what asset allocation is. Swing trading. Swing trading is when you're buying the ETF and you're holding the ETF for either one day up to a year, and you're trading the ETF like you trade a stock. That's called swing allocation. Sector rotation means that you're rotating from one ETF to another based on the economy, based on the sector. So what you'll find is that sometimes the technology stocks are hot, other times healthcare is hot, maybe transportation. And so you can rotate from one sector to the next. We talked about short selling. I would definitely, if you're thinking about short selling, I would do an inverse ETF. seasonal trends. We talked about that, I think, in week number 2, where we talked about really the economic cycle of business. You know, business is always not always great. The economy is not always great, but there are companies that do well when the economy is down. There's companies that do well when the economy is up. And so you can be riding the seasonal trends. You know, maybe with seasonal trends, you know that retail, we just hit Black Friday. We in the shopping season, and so you may move into a retail ETF during the seasonal holiday period. So maybe around November, December, you'll get into stocks for retail. And then, you know, in the summertime, you might get into something else. You know, you might get into, as you start getting into spring and summer, you might get into entertainment or travel stocks, because a lot of people are taking vacations. They're getting on Royal Caribbean. They're flying on United Airlines. And so that would be a seasonal type of trend that you would do with your strategy. Okay. And then hedging is, you know, that's betting on companies that would probably be some of your small cap companies that are out there, and you're hedging your strategy, your investment strategy. All right. How do we pick our ETF? We want to look at the asset class. So we want to know what class is this ETF in? What's the size of the ETF? How much money does the ETF generated? What is the index, the ETF index? How does it compare to the S&P 500? And so all of these are different ways that you look at picking an ETF, okay? And so what I want to do here, I was hoping that I would remember some of the ETFs that are out there, but I'm drawing a blank. Jeffrey Finch says, how do you feel about the Fidelity zero expense funds? Is there a gimmick to them because they're not making any money with no expenses? I really love the fact that Fidelity has done that. So let's go take a look at that for all of you that are here. Let's go take a look at that. We'll go to Fidelity zero expense funds. So Fidelity actually has some mutual funds that have no expenses whatsoever. Okay. So when we start looking at these, let's just take a look real quick. You'll notice that these are all mutual funds, and we know that they're mutual funds because their ticker symbol ends in the letter X. 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 So let's just take this first one, FNILX. We'll go over here to Morningstar, FINLX. Let me go back. FNILX. I'm sorry. FNILX. FNILX. So here's Fidelity Zero Large Cap Index. So we know what large cap means. So large cap is going to have, you know, companies like Microsoft in it, Apple, that type of thing. And so what you'll see here is you'll see that it has no expense ratio. No expense ratio. It has no minimum investment. So you can start off with $5 if you need to start off. It has no load. This is key. No load means it's not a loaded fund. And so I'm going to try to see if I can find a loaded fund so you can see the difference. But I love that Fidelity has put these together. I just love it. I love that they've put it together. Okay. Let me see if I can find a loaded fund. I want to give you a comparison. That's not what I'm looking for. Man, I wish one of y'all had um a fund that we could look at. This says Primerica Balance Yield Fund. I'm looking for the ticker symbol of the fund itself. I don't see it. I don't see it. I don't see it. Okay, here's one. AMHIX. So I'm gonna copy that. AMHIX. We're gonna go over here to Morningstar, and I'm gonna compare that. If you look at this, no load, you want a no load fund. You always want a no load fund. But I'm gonna compare that to what we are going to look at next. So we're gonna do that search there. AM. This is a municipal bond fund. Okay. Now, here's what we're looking at. This is key. This is key. You see the expense ratio, 0.640. That's way more expensive than 0.001 whatever, okay? You'll also see that it's front loaded. Here's what that means. That means that if you put $1,000 in, you're really not putting $1,000 in because they're going to take out whatever the front load percentage is. So what we've got to figure out is what the front load percentage is. Also, you got to have at least $250 to invest. So now what we want to do is we want to take a look at the fund itself and take a look at what is the front load on this fund. Okay, so I'm going to scroll down here. They got 59 holdings, equity holdings. That means stocks, companies. 2,955 bond holdings. Okay, so it just kind of tells us what some of the top stocks are. Okay, for the bond. We're going to scroll down, and what I'm looking for is I'm looking for what their front load fee is. So here we'll see the front load fee is 3.75%. So here's what that means. For every $100 that you put in, $3.75 is going to commissions to the financial advisor. So let's just say that you decided that you really wanted to start a fund, you want to start investing, and so you're going to put $300 a month into this fund. So you're going to multiply 300 times the 3.75%. And $11.25 is going to the financial advisor. So instead of you investing $300, we'll take 300 minus $11.25. You're really investing $288.75. That's what a front load means. You want to avoid front loads at all costs, okay? Because if you invest $300 a month and they're getting $11.25 each month, we can take 11.25 times 12. You're giving them $135 a year. Now, what if you invest it for the next 20 years? You gave them $2,700 to help you invest one time. And then if you take that $2,700 and you say, what could you have earned on that over the last 10 years, 20 years? You're probably looking at, $10, $15, $20,000 that it would have cost you by doing that. And so that's why we don't want to do loaded funds. Our expense ratios are very high. And if we go back and compare that, I'm going to open up Morningstar again, just on a different page here so you can compare it. If we compare that to FXAIX, the Fidelity Fund that you can go get by yourself, you don't need a financial advisor. Let's take a look at the expense ratio there. So this expense ratio is 0.015. This expense ratio is 0.64. There's a big difference between 0.64 and 0.015. This has no load. This one has a loaded fee of 3.75. Okay. So if you have mutual funds out there, if you have any type of mutual fund like this, you want to go to Morningstar, put it in, and it will give you all of this information here. Okay. All right. Hopefully that answered your question, Mr. Finch. Why would Fidelity do that if they're not making any money? Because they're bringing you in as a customer, and as a customer, you're probably going to do other things. Maybe you're going to have some money there in the checking account and all those other things. So, how do they make their money if there's no expense there? I don't know how they do that on that particular fund, but if you look at the funds, those funds have done pretty well. So Fidelity is a great company to do that with. I love that they've done that. Desiree, I think what your question is how many ETFs can you purchase? You can purchase as many ETFs as you want, but when you're doing ETFs, you just want to make sure that you got diversification just by having an ETF in itself. So if you bought an S&P 500 ETF, that covers you for that. If you decided that you wanted a technology ETF, then you could buy a technology ETF. But note that the technology ETF and the S&P 500 ETF might have some similar companies that's across the board in it. All right? All right. I think I answered that question. And Sonia, I answered your questions about the fees. Boom, boom, boom. Okay. All right. Mr. Ballard says, what about fees for Acorns ETF? So yeah, they're going to be fees on all of them. I go to Acorns ETF. And I don't know right off the top of my head what their ETFs are. But let's just see here. IJH. Take a look at that and see. See if I can put that in here. See if that pulls up here. So you're going to see that this is a 4-star ETF. With the 4-star ETF, you're going to see, scroll down here just for a second. You'll see that their expense ratio is 0.050. So again, you're able to compare expense ratios. And so for those of you that's asking, what is an expense ratio? An expense ratio is what you have to pay a professional to manage the fund for you. So for every dollar that you invest in this, you're paying a nickel for every dollar you invest for someone to invest for you. So if I take $1 and I multiply that times 0.050%, I'm paying less than a nickel. I'm paying like, I don't even know how to explain this. So 0.00 would be like 1 cent. If I put 1 there, that would be 1 cent. This is less than 1 cent. So this expense ratio isn't a big deal to have somebody professionally invest for you. It ain't even you're not even paying a penny per dollar that you invest. Okay. But when you start getting, point and a number right here, that expense ratio is a lot more than what you see here. So you definitely want to look at expense ratios, but you don't want to get too bombarded with expense ratios either. So do a comparison, but don't get too tied up into that. Okay. So you're charged $3 a month. That's their program that they're charging you $3 a month. They're not charging you $3 a month for the actual fund itself. The fund has an expense ratio. Fidelity charge, that's like a check for having a checking account. You got a checking account. Some banks charge you a couple dollars for having a checking account if you don't have but so much in that checking account. Okay. So that $3 a month that you're charged with Acorns, that's a different fee than what we're talking about here when it comes to expense ratios. Expense ratios, that's a different fee. That's a fee that Fidelity is actually charging. I mean, not Fidelity, Acorns. That's a fee that Acorns is actually charging. Okay. But it's not an investment fee. Yeah, subscription fee. That's a good way of describing it. It's a subscription fee. All right. All right. Good stuff. Let's move on because I gotta get this thing done. So that's the ETFs. This is where we want to go today. I want to make sure that you get this before we close out today. Because you're ready to start trading. Just about ready to start trading. And so what we've got to learn is we got to learn the trading orders in our brokerage account. So I want to give you a couple of orders here. So these are pretty simple to know. If you want to buy a stock, when you get inside of your brokerage account, you're going to click buy, and it's going to allow you to purchase whatever you want. When you're ready to sell, you click sell, and you can sell some stuff. When you want to sell short, so here's how selling short works. This is how it works if you want to make money when the stock market goes down. So let's assume, here's a good way of explaining it. You got I buy some tennis shoes. I got some Air Jordan tennis shoes. And right now, the Jordans are worth $500 a pair because it's the holiday season and everybody's looking for these shoes for Christmas. So what you do is you say, hey, June, I want to borrow your Jordans. I ain't never worn them. They're fresh in the box. They're a fresh pair of Jordans in the box. And you say, June, I want to borrow your Jordans for the next 2 months, 3 months. And I say, okay. So you borrow my Jordans and you immediately sell my Jordans on the market for $500. So you get $500 up front immediately. Now, within 90 days, you got to return my Jordans back to me. So what you're hoping is that after Christmas, the price of Jordans drops dramatically. So after Christmas, maybe the Jordans drop down to $300 a pair. You sold them for $500 a pair because everybody wanted them for Christmas. But after Christmas, nobody really wants the Jordans. The price of the Jordans dropped down to $300. And what you do is you buy a brand new pair of Jordans for $300, and then you return it to me, and you keep the difference. So you sold something that you didn't own, and you bought it back at a later time, hopefully at a cheaper price. That's what selling short basically means. So I sold your shoes that I did not own for $500 right before Christmas. And then sometime in January, maybe February, I bought those same shoes back for $300. I sold them for $500, I bought them back for $300, and then I gave you the shoes back. That's what selling short is. Okay? Now, to get out of the sell short, so I sell the shoes for $500. That's called selling short. I sold something that I didn't own. So I'm going to sell short first. Then for me to get out of that, I got to buy to cover it. So because it can be confusing. So I sell short the tennis shoes for $500. I don't own this tennis shoes. I essentially borrowed the tennis shoes and I sold them for $500 for whatever the market value is in the market right then. Now, at some point, because I sold something that I did not own, I got to buy it back to cover what I sold. So some time in the future, I'm going to buy to cover those same shoes, hopefully at a lower price than what I sold them for. And I keep the difference. I hope that made sense. I'm going to leave it at that. If it didn't make sense, pop a question in, but I'm going to leave it at that. Now, when we buy, okay, I got a chat that came in. Is that like buying a put in options? It's exactly like buying a put in options. That's exactly what you're doing when you buy a put in options. Okay? All right. But y'all didn't hear me say options because I ain't talking about options in this class. But yes, Barbara, it's the same thing as buying a put in options. Matter of fact, it's less risk when you do it in options. All right. Now, when you are actually buying, you can set a market order or you can buy at market. So imagine that you go to the farmer's market and I'm selling watermelons. And I'm selling watermelons for $10 a watermelon. Well, you can buy it for the price that I'm selling it for at market. That's market price. Or you can say, I'm going to set a limit. June, I'm not going to pay $10 for a watermelon. But if you drop the watermelon, if the watermelon price ever drops down to $8, I'll buy it. So here's what happened. I'm selling watermelons all day long at the farmer's market for $10. It's about 4 o'clock and the farmer's market closes at 5. I still got 100 watermelons left and I don't want to take them because they're going to spoil and all that good stuff. So I start dropping the price. I dropped the price down from $10 to $9. And so people come and buy. As soon as I drop the price to $8, you automatically trigger and buy those watermelons. So you can do the same with the stock market. You can say, I like Microsoft, but I don't like it at $380. I'm willing to buy Microsoft at $350. So I'm going to put in a buy order, but my buy order is going to have a limit of $350. And if it does not hit the $350, I won't buy it. It won't buy. Okay. Okay. Hopefully that makes sense. Okay. All right. You can also do the same thing for selling. You can buy, let's say I buy Microsoft at $300 and I say, man, if I made $50 profit on this, I'd sell it. So instead of me sitting there waiting for it to go to $350, I go ahead and put a sell order and I say sell at $350. I set the limit for $350. That way I don't have to look at it. I go on about my business and then I get a little bing on my phone and it tells me that your stock just sold for $350. I wasn't watching it. So you want to use these tools because they help you buy and sell stock. Once you determine the price that you want to buy and you want to enter in, you don't have to be sitting in front of your computer all day. Okay. Then there's a stop. And the stop basically says when the stock reaches a particular stop price, you got to get out, right? You just have to get out at that stop price. Okay. Select the stop to buy or sell a security when its market price reaches a specific stop price. Kind of confusing, but I'm going to show you guys what it all means. Okay. Man, some of this is good if I just go in and I just kind of show you. So what I'm going to do is I'm going to go into my trading account here and I'm going to just show it to you. Give me 1 second. I'm logging in. Don't want you to see my password. All right. All right. So we'll go here to trading stocks. All right. Let's share my screen now. I'm going to share my screen with you. All right. So you should be able to see my screen. We are here inside of E-Trade. And so this is what your screen is going to look like. And let's just say that I want to buy Microsoft. So I type in the ticker symbol, and it's going to tell me Microsoft. Now you're going to see that Microsoft's, the last price was $371.65. Okay. We're going to see the bid and the ask. 371 was the bid, 01. The ask was 371.65. So there was a spread of 64 cents there. Okay. Now, here's my action. I have the option to buy, to sell short, or to buy to cover. So let's go over each one. Let's say I want to buy the stock. So I'm going to click buy. And let's just say I want 100 shares. I want 100 shares of this stock. And then what price do I want? Well, if I do market means I'm buying it at whatever the price is right now. I want it now. I don't care what the price is. I want that watermelon for $10. Market on close, that means that right before the market closes, I'll buy it at whatever the price is when the market closes. Or a limit. I can set my limit. Okay. And then some of these other ones, I'm not going to cover these. I might cover them, but we're just going to do the limit. Okay. So I'm going to click on limit. As soon as I do limit, you'll see this box opens up and says, what's the limit price? I see that Microsoft's at 371. Here's what I want to do. I want to buy Microsoft at, let's say, 340. That's my price. So it tells me that it's going to cost me $34,000 to buy Microsoft, 100 shares of Microsoft at 340. Now, how long do I want this to last? Good for the day. That means that if it doesn't hit my price for today, then it cancels itself out and I don't have to worry about it. Or I could say good for the next 60 days. So I could walk away from this, and any day, anytime within the next 60 days, if Microsoft drops to $340, it's going to automatically purchase this for me. Okay. Good until date. So I can set a date that I want it to cancel at. Immediate or cancel. So I can immediately buy this right now. Okay. Or I can buy during extended hours. Remember, the market closes at 4 p.m., but there's some extended hours that you can participate in. Extended hours is from 7 a.m. to 8 p.m. So what I'm going to do is I'm going to say good for 60 days. All right. Now it says all or none. All this basically means is because I'm buying 100 shares, I want 100 shares at $340. Sometimes maybe only 50 shares are available at that price, and it'll get you 50 shares. If you click on all or none, that means that I want 100 at 340. If you can't get me 100 at 340, I don't want none at all. And then all I'm going to do is preview my order. So we'll click on preview order. It's going to tell me I want to buy 100 shares of Microsoft stock. My limit is $340, and this is good for 60 days. So then all I do is I come in here and I place the order. So we'll click on place order. Now you'll notice that it has accepted my order, $340. Now you got to have the money available to do that. So I got more than $34,000 there. So that's why it will allow me to take that. I got $34,000 and it can do that. Okay. And now I can set the alarm. So I can click right here where it has an alarm, and I can have E-Trade send me a notice when the stock reaches a certain price. So I can start watching it, right? So high price target, my low price target, whatever the case may be. All right. All right. Let's go back to trading again. We'll go back here to stocks. Let me see if I got some questions here. Yeah, Barbara, I'm going to do that next week. I'm going to show you how to do that in your Moomoo account because it's pretty much the same. But I'll show you that to you next week because I don't have my, let me see here. Let's do this. See if I can. Let me do that next week, Barbara, because I don't have my login on my phone. Oh, wait. Maybe I can do my Moomoo account here online. I've never used the one online here. So let's try it. Let's try it. All right. So here we are in my Moomoo account. And what I can do is I'm going to go here to paper trade. You see we can do stocks, but well, let me just do stocks. I'm going to click on stocks. That's not where I want it to go. I haven't done this here on my computer. I've always used the app. So let's see here. Let me download the desktop. Give me one quick second. We'll do this on Moomoo. Next week, what I'll do is I have my phone hooked up to the Zoom, and you can see me do it from my phone. I'm waiting for it to download the Moomoo app to my computer here. While it's doing that, let's go back over here to, let's see, has it downloaded yet? Let's go back over here to E-Trade and let's do another one. So if I want to do, let's just say Coke, K-O. It's going to be Coca-Cola. Again, this time, maybe I want to sell short. So if I want to sell short, it means I want to sell Coca-Cola, and maybe I want to sell 10 shares of Coca-Cola. I want to sell it at the market price. Market price is $559. So I'm going to receive $590.39. Okay. I'm going to do good for day. I'm going to preview the order. So what it's going to do is it's going to sell. You see where it says estimated proceeds? It's going to sell, and I don't own any Coca-Cola. It's going to sell Coca-Cola, 10 shares of Coca-Cola for $59.66. Well, this is what I'm going to receive. I'm going to receive $590 into my account. Now, I'm not going to place this one because I don't short stocks, but I just sold something that I did not own. And then later, I'm going to cancel this right now. Let me cancel this before I make a mistake. Then later, I have to come back in. KO. Later, I'm gonna have to come in and I'm gonna have to buy to cover the 10 that I sold. And then I'm gonna try to get it at a price that's lower than what I sold it for. So if I sold it for $59, maybe I'm gonna come in here and try to buy it back for $49. And so now you'll see that my total cost is $490. So I made $590 when I sold it, and then I had to buy the cover, and it cost me $490 to buy it back. So the difference is $100. Hopefully you guys understand that. The difference is $100. Can we do day trading on Moomoo? Yes. Yes, you can do day trading on Moomoo. Why would you want to? Well, yes, you can do you can do day trading on Moomoo. It's not something that I'm teaching you. I'm not teaching you to do day trading though, but you can do day trading on Moomoo. All right. Anybody know why I don't teach day trading? Anybody know why I do not teach day trading? Risky. Absolutely. It is absolutely risky. Okay. You can swing trade. Anybody know what the difference between day trading and swing trading? Anybody know what swing trading is? Yeah, I love that, Barbara, because that's funny. Barbara says it's risky and we're old. And she hit it on the head because at this point, most of you are probably not in your 20s and you don't have time for it to for you don't have time. So here's what I mean. I'm 53. That means that I'm going to need my investment money within the next 10, 15 years. So by the time I'm 63, maybe 67 years of age, I'm going to need to start using my money that I've been investing for all these years. Well, that's only 10 years from now. What if I go out here and I start day trading and I blow my account? I don't have enough time to rebuild it and be able to use it 10 years from now. So I don't teach day trading. I think that day trading is risky. Obviously, people make a lot of money day trading, but unless you know for sure what you're doing, I probably wouldn't day trade. Don't get excited about all this stuff that you see on the internet where people are, man, I made 1,000% return and I did this and I did that and I made $1 million. If it were that easy, everybody would be doing it. If it were that easy, June Collier would be doing it. I'm here to tell you that you can't believe everything that people say. Have them show me your trading account. Show me what you're doing, right? There's a lot of risk that's into that. But swing trading is holding one day. Somebody says from one day to 2 weeks. Swing trading is actually one day to 364 days. I can buy stock today, get out of it today. That would be day trading. Buy stock today, get out of it next week, get out of it 6 months from now, get out of it 11 months from now. That's called swing trading. I believe that you could successfully do swing trading, especially with what I've taught you thus far. Um, I'm not that good to do day trading. Okay. I just heard Dave Ramsey tell someone he sucks at day trading because he lost all his money and to stop doing it. Absolutely. I mean, I don't agree with everything that Dave Ramsey says, but that is definitely true. And so we want to be careful with that. We want to be careful with day trading. Okay. Where is my moo? There's my moo right there. I'm gonna have to show y'all this next week because I was not prepared to show you moo. I wasn't prepared to show you moo tonight, and it's taking me too long. Okay, so yeah, okay. Let me do this. Let me stop sharing. I wasn't prepared. I wasn't prepared. In all transparency, I've used Moo, but Moo is not my go-to. The only reason why I did Moo was simply because Moo allowed me to teach the class without you guys having to pay for the class. So that's why we use Moo. 562 928. Uh-oh. I don't know if I remember my I don't know if I remember my password. We'll do this. We'll do this next week. We'll do this next week. My apologies for not having that ready for you, but I wasn't planning on doing that. Okay. All right. So let's take some time here to ask some questions about entering and exiting trades. So I'm gonna go back and share my screen, and I want you to ask me any questions that you have, basic questions about entering and exiting trades. Remember, this is a basic course for beginners, so I'm not going too deep. So you might say, well, June, why are you not covering trailing stop and trailing stop percentage, trailing stop dollar, stop limit on quote, stop on quote? Because it's a little bit more advanced and complicated. So I'm going to do a trailing stop. I'll give you an example of a trailing stop. Let me do this. This is what a trailing stop is. Let me see if I can explain it to you in a diagram. I'm going to go over here and I'm going to open up Google Docs and I'm going to show you what trailing stop means. Okay. Now, I like trailing stop, especially when the stock is going high. So let's just say that you bought the stock for $10 and the stock is going higher. The stock just went to $15. Now you could cash out at $15 and make a $5 profit, but then it goes to $20. And you like, man, this thing is going to the moon. I just doubled my money. And so what you may do is you may do what's known as a $5 trailing stop. So down on this end, I'm going to put in what's known as a $5 trailing stop. Okay. So what that means is as long as I'm in this trade, because now I'm in this trade, I can't lose. I can't lose. Because if the stock goes to 20 and then it stops at 20 and it drops $5, it drops all the way back to 15. As soon as it hit 15, I automatically sell because I'm not going to let it go all the way back to 10. But what if it doesn't drop? What if it goes to 20, 25? So now the $5 trailing stop it follows it up to 25. So now if it drops, if it goes all the way up to 25 and then it pulls back $5, it's going to get me out at 20. But the stock just keeps going higher. It goes to $30. And at some point it's going to stop and it's going to do a reversal. And what I'm doing is I'm following the stock $5 behind. I'm trailing the stock $5 behind. So if it goes to 30 and it pulls back and turns around, if it drops down to 25, that will get me out of the stock at $25. So we use a trailing stop to trail the stock. We're like, let me see if you guys can see me. I want to show you what it looks like. This is the stock. This is your trailing stock. Your stock goes up with the stock. And then once the stock stops going up higher and it starts falling down, boom, it hits the $5 trigger and then it sells at that point. Does that make sense? Does that make sense to everybody? The trailing stop. Anybody not follow the trailing stop? So the reason why you would use a trailing stop is if, because sometimes we get greedy. We can get greedy. And if you don't use a trailing stop, what will happen is the stock will go up and you think it's going to go up forever. It's not going to go up forever. And then the day that you weren't watching it, you had to go to your kids to the school or something like that, the stock drops and you didn't have a trailing stop and you lose all of the gains that you made. So what a trailing stop does is you set the trailing stop. Once the stock goes up so much, you then go in and you set the trailing stop and it follows the stock. And when the stock stops going up and it comes back down and it hits here, then you sell. Okay. So that's a way for you to get as much of it as you possibly can. And so when we look at the dollar amount, you can either trail it by a dollar amount or you can trail it by a percentage. So when we look here, this is what this is. I'm doing a dollar amount or a percentage. So I can say, I don't want to lose 5%. So what I would do is I would set my trailing stop 5% behind. So you can either sell it by a dollar or you can set it by a percentage. Okay. Now, are there questions on these? Because these are just your basics. I don't want to get too deep into anything else. Is there a question on buying? Buying is pretty simple. Selling is pretty simple. Sell to short and buy to cover. Anybody struggling with sell to short or buy to cover? I want to make sure that you understand this. And this is going to work across, no matter what platform you have, it's going to work across all of those platforms. Okay. I don't see anybody with their hand raised or anything with a question. Okay. What about duration? Or I'm sorry, the price type. The market, that's whatever it's selling for right now. I want to get in or I want to get out immediately. Market on close. This is going to be, I'm getting out at whatever the price is right before the stock market closes. Limit. Limit is I'm setting a limit order. Okay. I'm not going to do these other ones. Just setting a limit order. Any questions on those? I'm looking to see if there's any hand raised or any questions that's coming in on those. Okay. And then duration. Hold on, I got a question that came in. Will it trail for a day? Like it opens at $15, but up and down during the day, it will sell at $10, or if it goes up to 18, then it will automatically go up by 5. Yeah, so as long as the stock keeps going higher, the trailing stop follows it. When the stock stops going higher, the trailing stop gets locked right here. It locks. And then if it doesn't go any higher than what the highest point it was, the trailing stop won't do anything. But then if it continues to go higher, the trailing stop will go higher with it. And then if it stops going higher and it starts coming back down, the trailing stop gets locked at that point. Okay. So if I have let's say the stock is at $15 and I put a $5 trailing stop on it. The stock goes to, so what that means is if it's at 15 and I got a $5 trailing stop, I'm going to get out at $10. But then the stock goes to $16. Well, $5 below 16 is now $11. So the most that I would get out at $11. If it goes up to $17, the stock goes up to $17. My trailing stop goes up by $1 and I get out at $12. So that's a great technique to use if you want to capture as much as you possibly can. Okay. That's what a trailing stop is. Okay. Now, let me go cancel this order here. Let's see. Click over here where it says orders. And I can cancel. I'm going to cancel that order that I put in for Microsoft. Cancel that order. Okay. And now the order has been canceled. Now, what I'm going to do is, it doesn't matter what trading account you're in, they all look very similar. So what I'm going to do is I'm going to log out of E-Trade. I'm going to log into my Charles Schwab, and I'm going to show you that they are very similar in nature. Okay. So let's go over here to Charles Schwab. And then next week, when we come back to Moo, did I spell that right? Charles Schwab. Okay. All right, I'm gonna stop sharing just for a moment. We'll log in, and then I will share back again with you guys. All right, let's go to trade. And I'm gonna trade stocks. Okay, so let's go ahead and share my screen with you. Now, it looks different, but it's the same. So every brokerage account is going to be a little bit different, okay? So here, we are getting ready to trade a stock, okay? So we are looking at stocks and ETFs, okay? So we want to enter our symbol. So I'm going to go Microsoft. Boom, it pulls up Microsoft. It's going to tell me what the price of Microsoft is, the volume, all of that. And then it's going to ask me, what's my action? I either want to buy, sell short, or buy the cover. So I'm going to click on buy, and then it wants to know how many shares do I want to buy. So I want to buy 100 shares, okay? And then it says, what do you want to do? Do you want to do market, limit, trailing stop, market on close? Well, here's what I want to do. I want to do a limit, and I want to, since it's at 371, I want to buy this at 335. And then it says, how long do you want to do this? For the day? For the day plus extended hours? So this is a little bit different than E-Trade. It says the day plus extended hours. So that means all the way up to 8 p.m. Good till cancel. That means good until I come in here and I cancel it. Good to cancel plus extended hours. Okay. Maybe extended hours in the morning, because I can trade early in the morning before the market opens, or extended hours until the PM. So it varies just a little bit, but not so much that you don't know what's going on. So in this case, I might say good till cancel. When do I want to cancel? I can go select on the calendar, and right now I got it in, it's at June 7th of 2024. But maybe I want to do January 1st, right? Market's not even open on January 1st, but so now it's telling me that this is going to be good for 21 calendar days, or until filled or canceled. All right. And so I'm going to be purchasing $33,000 worth of Microsoft if it drops to this price. Okay. If it drops to this price. Okay. It tells you what the 52-week range is, all of that stuff. Tells you in this particular account, I have 642 shares of Microsoft in this particular account. So it tells you that. It also is going to tell you available cash that you have to invest. So this tells you that I can make this trade of 33,000 because I've got 54,000 cash in this particular account, okay, that I can trade with. All right. And then your drop down here will be the different accounts. So this is a rollover IRA. So I don't worry about trading in and out of this account and having to pay taxes, because it's already a tax deferred account. But then I also have a Roth IRA. So we've got a Roth IRA that has pretty much the same. Now, what you'll see in my Roth IRA, I can't make this trade because the available cash I have in my Roth IRA is only $216. So this will probably give me an error if I try to go through on this. And then on my Roth IRA, it shows you that I have 133 shares of Microsoft in the Roth IRA account. Okay, so everybody see that? So everything is pretty much the same across all of your platforms. It's just going to be your basic information. As long as you understand the basics, it doesn't matter whether you're doing Ameritrade, whether you're doing E-Trade, whether you're doing Moomoo, whether you're doing Charles Schwab, they all are pretty much the same. Okay. All right. Let's see if there's any questions there. No questions. All right. All right. No questions. I'm going to leave it at that. So we are going to log out of this. We'll stop there. And we'll have the replay for you guys tomorrow. Are there any questions before I let you guys go for tonight? Any questions? Want to raise your hand? I'll unmute you or whatever. Okay. So I don't see any question. Oh, there we go. Miss Sonia. Miss Sonia, go ahead. You can unmute yourself, Miss Sonia.
I just had a quick question. When is the last day? Is this week the last day, or we're going into January?
No, I'm going to continue on because I'm tired. I got some things going on in my personal life right now, but I don't want to cut you guys short because there are a few other things that I want to teach, and it's not fair if I just cut it short right now. So we have at least one more week, maybe 2 weeks. I'm going to try to finish up before January. So I think we got two more weeks here in December for us to do the training.
All right, great. Thank you.
My pleasure. Anybody else? All right. Is there a time frame in which you have to buy to cover once you sell short? So great question, Ms. Johnson. So what ends up happening is your brokerage account will basically give you what they're basically looking at is, do you have the money to cover it? So you can sell something, but you still have to sort of have the cash available to cover that. And if it starts to run away from you, then they're gonna make that transaction happen without you doing anything about it. They're not gonna lose money. So if let's just say you sold it for $500, in that case we sold it for $500, and we're going to try to buy it back at a lower price. But instead of buying it back at a lower price, it goes higher. So it goes up $60. So now we got $600. Well, you need to have $600 in your account to cover that. And so if it continues to go higher and higher and higher, the brokerage account is going to look and they're going to call it in. They're going to call it in. And that's why I don't like doing it, because I don't like shorting stocks, doing a buy to cover. You can make some good money doing that, but you're taking a lot more risk. And then if it gets away from you, your brokerage company will actually sell your shares of other stocks that you own in order to cover that trade. So I don't want them selling my Microsoft. I had that Microsoft for a long time. It took me a long time to build up my shares of Microsoft. But if I get it wrong and the stock starts to run away from me, I got to buy it back at some point. And if I don't have the cash to buy it back, then what they'll do is the brokerage will automatically start selling some of my shares to buy it back. And I don't want them to do that. Okay. All right. We'll do this again next week. And I think next week might be the last time, but we'll do it again next week. And I'll go back and put in some quiz questions for the weeks that I forgot. Okay. Until then, God bless, take care, and good night, everyone.